everyone, hello all, this is the think tank and welcome to another session, guys. So this is going to be a continuation once again on the series of on fixed assets. So today we are going to be answering a question paper from November 2021. It was a very difficult question paper, by the way, but that's fine. I'll try to simplify the concepts as much and as best as I can. So from wherever you are, please take out a piece of paper or your workbook and then have a calculator as well, because we are about to do some calculations and also apply the knowledge that we know about accounting for fixed assets. Remember, when we are talking about fixed assets, we are talking about immovable assets. So these are tangible assets that are used in the production of income. So they are used in the production of income. So these are the assets that you need to do what? To conduct your operations. So because these assets were initially bought not necessarily to be sold like trading stock, but they were bought to produce income, it means that they stay in the business for a much longer period because we are using them, right? So that's fixed assets. So we said that fixed assets, on the previous video, we said that fixed assets, they wear and tear. So that means that they depreciate over time. As you are using them, their value is going to go down because of wear and tear. Ayaguga. So in accounting, there's a term for uguga, which is called depreciation. So accounting for fixed assets is what makes it complicated is the fact that you've got to account for the depreciation. But we went through that on the previous video about fixed assets before this one. So if you want a more detailed explanation, please go back to that video. However, the diagram that we had on the previous video, we need to have it again in this video so that I explain the thinking process. The thinking process. Remember this diagram, this one is a flow chart. So it explains the thinking process that you need to have as you approach transactions or adjustments that relate to depreciation. Remember, I said when you read the transactions, you first look for the cost to say how much did it cost to buy a particular asset, or how much did a particular asset cost the business. So you look at the cost, and remember here, if they tell you that the cost includes VAT, before you record that amount, you must exclude VAT. That's very important. So if the amount includes VAT, if the amount of the cost price of an asset includes VAT, when you record the asset on our records, you must remove VAT. Remember, according to the historical principles under the GAAP principles, it says that assets of the business, they need to be recorded at their historical cost price. So we must remove the effect of VAT if a transaction includes the VAT. And then from there you ask yourself this fundamental question to say, okay, what type of an asset really am I working with here? That's what you would want to know. Okay, what type of an asset are you working with? What type of an asset are you working with? And then let's say you are working with equipment, you'd ask yourself, okay, am I calculating depreciation for equipment that is old? Am I calculating depreciation on equipment that is new, that we've just bought? Am I calculating depreciation on equipment that I've sold? Why do you have to ask yourself this question? You've got to ask yourself this question so that you know how to account for time. So that you know how much did a particular asset, for how long was a particular asset in use before we decided to sell it. So that's why you've got to ask yourself, what type of an asset am I dealing with? If the asset is old, for an example, if the asset is old, so that means that you depreciate from the beginning of the year to the end of the year. If the asset is old, because it means that you've been keeping the asset and you've been using the asset. If you've just bought a new asset, that means that when you have used that asset from the date at which you bought the asset up until the end of the financial year. Okay, let me repeat. So if you bought a new asset, you are going to account for depreciation on that new asset from the date at which you bought the asset, which is the date of purchase, up until the end of the current financial year in which you are preparing the financial statements for. I hope that makes sense. And then if you sold an asset, so if you sold an asset, you are going to calculate the depreciation of that asset. Let's say you want a depreciation of that asset on the current financial year that you are working with. So you are going to have to calculate depreciation, current year depreciation of that asset from the beginning of the year, because we've been using the asset up until the date of the sale, which means up until the day you decide to sell the asset. And up until the day you decide to sell the asset, and then from that day on, the asset is no longer in use because we've sold it again, so you can't account for a depreciation of the particular asset. So that's why here we said that here the depreciation is from the beginning of the year up until the date of the sale. I hope that makes sense. If you did not understand, you can just pause the video and rewind and then listen again so that you understand. If you don't understand here, you can go on the previous video. I explained the same things as well. And then from there, after you know which type of an asset are you working with and the number of months, which is time that is involved, what you do next, you look for the depreciation method. So I'm breaking down the adjustment now to say the first thing, you look at the cost of an asset. From the cost, you ask yourself, okay, what type of an asset are you dealing with? Okay, if that's answered, you go on now to ask, okay, what type of depreciation or what form of depreciation method was used to depreciate the asset. So if the asset is depreciated on cost, and then that means that you'll say cost multiplied by the depreciation percentage. And if the asset is depreciated according to the diminishing balance method, how are you going to account for depreciation? So you simply say cost minus accumulated depreciation multiplied by the depreciation percentage. So that's the formula that you use. So we are going to apply this now. We are going to apply this logic on real life transactions, which means that these are adjustments and transactions from the question paper 2021. So 4.2, paper 2, 2021. So here they're saying that the information relates to the fixed or tangible assets of just time, Pty Ltd. This is a private company, and then their year end is 28 February 2021. So we're mostly interested in this. What is this? This is the financial year. So we know now that our financial year is from 1 March to 28 February. So that's what we know. And then list 3 internal points for good internal control over movable or fixed assets. So this is just theory, guys, that you can go and look in your textbooks or even on the memorandum. And so I don't think there's really much that I would have to explain here. This is just theory, guys. You can go and look it up. My interest is from question 4.2.2. So here they are saying that the cost of land and buildings purchased on 31 August. So what calculate the cost of land and buildings purchased on 31 August 2020 4.3.2. Okay, let's start with this one. We are going to calculate the cost on land and buildings purchased on 31 August 2020. So through this, we know now that already we are given what we bought land and buildings. So we acquired additional land and buildings, and we acquired additional land and buildings. And then let's see now in terms of the adjustments. Okay, here we are told that if you look at the balance sheet for the year end 2021, we are told that land and buildings have changed from 5.5 million to 6.25 million. So that means that there was an increase of how much? There was an increase. So that means that there was an increase of so it is 6250 minus 5,500. So 6250 minus 5500. So there was an increase of 750,000. So this was the change. So this was the change in land and buildings. So let's see now, what do they tell us on adjustment B? Glamour Construction provided an invoice on 31 August 2020 after completing the new storage facilities. Okay, it's fine. The full invoice amount was paid and debited to land and buildings. However, the auditor found that the repairs for the old storeroom, 60,000, were included in the invoice. So this has not been corrected. So what this simply means, it means that on this amount, which was the change, which was the change in the land, in the cost of land and buildings, 60,000, which does not belong here, was included. So that's basically what they are trying to tell us here. Remember, I first calculated the change, which is the difference from year 2020 to 2021, to see how much has the land and buildings balance changed, and we realized that it changed by 750. So we assume, in quotation marks, the 750 was the cost of the new equipment, but you are told that on the cost of the new land and buildings, there is 60,000 rands, which belongs to which is an expense, by the way, for however the auditor, for the repairs. So this is the repairs expense. So it's not supposed to be included in the 750,000. So how are we going to calculate this amount then? So 4.2.3. 4.2.2, sorry. So this is what you'll do, 4.2.2. So you'll say, okay, my additional equipment, which is 750,000, then you subtract the 60,000. So you are looking for the actual additional land and buildings that were bought during the year. So 750,000 minus 60,000. So this will give you 690,000. This was the new land and buildings that were bought during the year. Why did you minus 60? The 60 was included on the 750, but it does not belong to the 750. Why? Because repairs are an expense. So repairs, this is an expense. So you can't record an expense as an asset. So that's why we are removing repairs. This was an error that was made by the accountant. So the actual additional land and buildings that were bought for the year is 690,000. I hope that makes much more sense. 4.2.3, calculate depreciation on vehicle for the year ended 28 February 2021. So remember, all the time when you are calculating depreciation, you must compare the depreciation that you calculated and you must compare it with the carrying value. Always do that so that you don't find yourself having to have a negative carrying value, just like the example from the paper that we did on the previous video. So it's very important for you to be on the lookout for that. So but let's see here what we have. Let's see what we have here. 4.2.3 adjustment. The company has only one vehicle and is depreciated on 25% on cost. So what is the cost of this vehicle? Let's come here. They are telling us that it's 480,000. So this is the cost. Remember, from this diagram I said you start with the cost, which is 480,000. And then let's come back. Then we are also told that is depreciated on 25% on cost. So the method is the cost method, and the percentage is 25%. And so already you have an idea of how we are going to depreciate this. And then what's this? Is it a new, old, or sold asset? This is an old asset because it was there even last year. So it means that it will depreciate for 12 months. So now let's calculate the depreciation. So that means that you'll say, okay, my cost, which is 480,000, then multiplied by the depreciation percentage. Remember, it said that we calculate depreciation on 25% on cost. Let's come back. This is 25% on cost, and then it's an old asset. So this is an old vehicle, so the times 25%, and then here is 12 over 12, which is 1. You don't have to do that. So you are going to have 480,000 multiplied by 25%, which is going to give you 120,000. It's going to give us 120,000. Okay, I just want to confirm the cost. If it's 480, yes, the cost was 480 multiplied by 25%. So this is the depreciation that we'll get on the vehicle, but we must be aware. Let's check now if we calculate the carrying value, are we not going to get a negative carrying value? If you get a negative carrying value, we need to limit this depreciation for the year. So let's see the carrying value. So it's 480,000 minus the carrying value last year 450. The accumulated depreciation is 450. So what will you do? Is it minus 450? So the carrying value already is how much? Is 30,000. So this is the carrying value, is 30,000. The carrying value is 30,000. So what does this mean? So this is the carrying value from last year's balances. So what does this mean? It means that the depreciation for this year must not exceed 30,000. Already when we calculated the depreciation, we already have 120,000. Can you see? So our depreciation must be limited to 30,000. Must not be more than 30,000. So that means that we need to have a 1 rand carrying value. So you'll apply the 1 rand carrying value method. So that means that the depreciation for the year, this year, is going to be how much? So in order for the carrying value to be equal to 1 rand, So you want the carrying value to be equals to 1 rand. And you want the carrying value to be equals to 1 rand when you minus this year's depreciation. So that means that you'll say 30,000 minus 1. So this will give you 29,999. So this is your depreciation for this year. And the carrying value is going to be how much? The carrying value is going to be equals to 1 rand. Carrying value is going to be equals to 1 rand. So what is the depreciation when you answer the question? So the depreciation is equals to 29,999. How did we get to this 29,999? We compared this year's depreciation, which was 120,000, we compared that with the depreciation, with the carrying value, from last year, which was 30,000. And the depreciation for this year must not be more than current year depreciation must not be more than how much? Must not be more than the carrying value last year, which is 30,000. Because if IBA more than, it means that you are going to end up with a negative carrying value, and you don't want that. So to avoid that in accounting, we apply this principle of having carrying value of imalini of 1 rand. And so that means that from this limit that you have, which is 30,000, you are merely going to subtract 1 rand, and then you're going to get 29,999. So that 29,999 is going to be your depreciation for the year. So they won't tell you that the depreciation exceeds the carrying value from last year. They won't tell you, so you'd have to check that from time to time, or in every question that you do, you'd have to check if it exceeds. And then if it exceeds, and then you are going to apply the 1 rand method. And I hope this makes sense. We did that last week as well. We are doing it again in this transaction as well. So please be aware of such questions going forward. 4.2.4. 4.2.4. So here you are told that the business depreciates equipment on 30% on the diminishing balance. So we are working with equipment, and and then we are told that the equipment is depreciated at what? At 30%. At 30% using the diminishing balance method. So that simply means that you are going to depreciate your equipment based on the carrying value. Okay, let's read further. So they tell us that on 30 November they decided to trade in a photocopy machine for a new model. So they bought a machine and then sold the machine at the same time. Calculate the loss on the photocopy machine that was traded on 30 November. Calculate the depreciation on the new machine and on the remaining equipment for the year ended 28 February 2021. So this is a very complex transaction, hence it's going to be 14 marks in total. So let's break it down. So the first thing that you need to accept here is that you had equipment. If you look at this, you'll see that we had equipment last year, which was 2.1 million again. So this is the equipment that we had last year. So the point that I'm trying to drive is that the equipment changed from 2.1 to 2.190. And at first glance, you'd say, okay, we had an increase of about 90,000. But remember, we bought new equipment and sold equipment as well. So this change that happened is a change that was caused by the old equipment that was sold and the new equipment that was bought. So that's the net between the two. And so this does not necessarily mean that we increased our equipment by 90,000. And it just tells us about the change to say we bought new equipment and then we sold old equipment. So we need to calculate depreciation on the old equipment, on the sold equipment, and on the new equipment that we bought. And so it's going to be a lot of work, but let's get to it. Here you are told that the equipment is depreciated on what? Is depreciated on 30% on the diminishing balance method. That's what we are told, okay? So the method here is 30%, okay? And then the old equipment, the new equipment, how much was it? So the new equipment here, we are told that, let's read this transaction together. A photocopy machine was traded in on 30 November for 88,000. So this is more like your selling price, in quotation marks. And then the cost of the new model was delivered on 1 December is 410. So the new equipment that was bought, is 410. So the new equipment, you have 410,000 worth of new equipment. And then let's see what about the old equipment that was sold. So the sold equipment, the cost here corner is 320,000. So we'll have to record this as well. Sold equipment, the cost is 320,000. And so this will depreciate it from 1 March to 30 November, which is 9/12. And then this, because we bought it on 30 November, it stayed December, January, February, which is going to be 3/12. And then the equipment layer last year, of which cost a corner is going to be the 2.1 million. So this is the cost price in 2021. So we'll take this 2.1 million. Remember, in this 2.1 million, this was before we sold the equipment that was worth 320,000. So to calculate the cost of the old equipment, you'll simply take this 2.1 million, and then you'll minus the 320,000, and then you'll get 2.1 million minus 320,000. So we'll get 178 or 1.78 million. And so this is the cost of the old equipment. So the old equipment is going to be 1,780 million. So now we have information about the new equipment, the old equipment, and the equipment that we sold. So we have all the information that we want. And then we also have the months in which we are going to depreciate these equipments. And then we also know that the method of depreciating is the diminishing balance method. So let's do the calculations once and for all. Let's do the calculations here. So we'll start with the new equipment. So the new equipment, depreciation is going to be equals to 410,000 multiplied by 3 over 12, because it stayed for 3 months, and multiplied by 30%. There is no accumulated depreciation here. Why? Because the equipment stayed for only 3 months. So we used the equipment for only 3 months in the current financial year. So that's the total. And then the sold equipment, what's the depreciation? So remember, this one we depreciated from the beginning of the financial year up until the end, up until the day we decided to sell. So it's going to be, the depreciation is going to be 410,000, sorry, not 410, 320,000, which is the cost, minus what? Minus what? Minus the accumulated depreciation. Minus the accumulated depreciation. Remember, we calculate depreciation on the diminishing balance method. So we will minus the accumulated depreciation, which is hopefully given. Let's see. Okay. Okay. If you look at this, yes, we are given the carrying value. So we'll use the carrying value. It's very simple. We'll use the carrying value. Carrying value means that the depreciation has already been, accumulated depreciation has already been subtracted. So we'll say 224,000 multiplied by, so this is the carrying value. So on the cost, the accumulated depreciation has already been minus to get the carrying value, so which is what we need to calculate the accumulated the depreciation for the sold equipment. So what is going to happen from now, we will ask ourselves, before before we sold this equipment, how long, or for how long did we use it? So remember, if you go back to our diagram, and then you'll see that we used it for 9 months. So you'll come back here and say 9 over 12 multiplied by 30%. So you'll have 224,000 multiplied by 9 over 12 multiplied by 30%, which is going to give you a depreciation amount of 50,400. So depreciation for the sold equipment. So before siwuthengisa lo machine, it depreciated for around 50,400. So this is going to be recorded as an expense, of course. And then the old equipment. So the old equipment now, so the cost corner, remember we calculated it to say the cost of the old equipment was 1.78 million. So 1780. How did we get 1780? We took the cost of equipment from last year. So we said 2, which is the cost of equipment from last year, and then we subtracted the equipment that we decided to sell, which is the cost corner is 320,000. And then the accumulated depreciation. Remember, if you sell an asset, it means that from the accumulated depreciation of the assets, you also need to derecognize or to remove the accumulated depreciation of the asset that you sold. So what does that mean? It means that on the accumulated depreciation of vehicles, which is how much? Which is 144. So it's 1.4 million. So 1440. You'll remove the accumulated depreciation of the sold asset, because here we removed the cost of the sold asset. We also removed the accumulated depreciation of the sold asset, which is 96,000. So you'll remove here 96,000 as well. Yeah, and then what carrying value are you going to get? So you'll say 2. So 1 2 1 2 3 minus 320,000, which is going to give us 1780 million. Then 1440 minus 96,000, which is the accumulated depreciation of the sold equipment. 1344,000. Then all this over 1780,000 minus 1344,000. And it's going to give us a carrying value of 436,000. So this is the carrying value. This carrying value of 436,000, we'll use it to calculate the depreciation of the old equipment. So it's going to be 436,000 multiplied by 0.3, which is the depreciation percentage. And then it's going to give us how much? It's going to give us 180,800. So the total depreciation on equipment is 180,800 plus depreciation on the sold equipment, which is 50,400, plus depreciation on the new equipment, which is 3750, which is 3750. Then this is going to give you a total figure of 180,800 plus 50,400 plus 3750, which will give you 211,950. So this is what will go to your income statement. Okay, let's see now if you have answered everything here. Calculate the loss on the photocopy machine that was traded in. So calculate the loss on the photocopy machine that was traded in. So what you do for this, you will say to calculate the loss, uzothi the selling price minus the carrying value of the machine that was sold. So the selling price here, I said this represents the selling price, remember here. So this 88,000 represents the selling price. So you'll say 88,000, minus the carrying value of this sold asset. So remember, the original cost of this asset is 320,000, and then last year we depreciated it for 96,000, and then this year it also depreciated by how much? It also depreciated by 50, yes, 50,400. So minus 50,400. So this is accumulated depreciation last year, and then this is the depreciation this year on this asset. We want the carrying value. So you will say 320,000 minus 96,000, then minus 50,400. Then this is going to give us a carrying value of 173,600. And then the loss here, you'll say 88,000 minus 173,600, and then it's going to be, the loss is going to be 85,600. So this was the loss. Let's see if we've answered everything. Calculate depreciation on the new equipment, done, and the remaining equipment, done. Calculate the loss, yes. So we are done, guys. As you can see, this was a very intense question, but this is the level, guys, at which you must you must this is the level at which you must get used to. And so it's a lot of things that I spoke about here. They tested the one rand carrying value method on the vehicles. They tested as well your knowledge on depreciating the different types of equipment. So we depreciated the old, new, and sold. And that on its own was a lot of work as well. And they also tested as well some internal controls, of which you are going to go and look on the book on your own. It's just theory that you just need to know. But anything more than that, guys, that's it for this video. It's very long, very intense as well. So if you get tired along the way whilst watching this video, it's okay to come back some other time and continue, because it covered everything basically, and it covered everything. If you have questions, please feel free to send us a WhatsApp. There's a link on the description below. If you'd like to order our study guide, there's also a link on the description below to order our study guide. If you would like to be part of our premium mentorship program for Matric, there's a WhatsApp link below as well. You can contact us. But anything more than that, guys, have a good evening wherever you are, because I'm recording this here in the evening. So we'll see each other on the next video, guys.